All right, so joining us today, we have Christopher Whitaker. He is our Senior Financial Advisor and Senior Financial Planner here at Apriem. His unique role serves the firm clients in many facets of all of their finances, especially on the multi-generational wealth management and client education side of things. He obtained his bachelor's degree from Point Loma University in San Diego, California, and advanced credentials from the Boston Institute of Finance. Chris is married with 2 young children that happily take up all of his free time.
Yes.
And he'll be joined by Joshua Garland. Josh is another one of our financial advisors here at Apriem. He serves as our in-house expert on insurance and has a knack for understanding emerging technology and trends. Josh is also married with 2 preteen children, and he happily tries to take up all of their time. And with that, I'm going to go ahead and hand it over to Josh and Chris.
Perfect.
Thanks, Megan.
Thank you, Megan. Crypto is not regulated by the SEC. And so I think it's very important that everybody understands that everything we talk about today is meant to be taken for educational purposes only. We will not be offering any kind of recommendations, and nothing that we discuss today should be a recommendation or taken as a recommendation to whether buy, sell, or actively trade cryptocurrency in general. So what are we going to talk about today? This is our discussion ledger. We're going to start out by covering Crypto 101, where we'll go through the fundamental concepts of cryptocurrency, really some of those key terms that you hear most frequently that come up quite often, and we're going to break those down and really what they mean. Then we're going to get into addressing some of the most frequently asked questions that we've really come across when it comes to crypto in general. And then we're going to look at what's happening in the news today. What are some of the implications of what could be coming in the future moving forward? And then we'll really look to address any of those questions that you guys have. With that said, I'm going to go ahead and get us going with Crypto 101. So if you were to hop onto Google right now and type in what is cryptocurrency, you're going to get a nice list of options that are on there. And their definition for cryptocurrency is shown here on the screen. I'm just going to read it to us here really quick. A cryptocurrency is a digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. Many cryptocurrencies are decentralized networks based on blockchain technology, a distributed ledger enforced by a disparate network of computers. A defining feature of cryptocurrencies is that they are generally not issued by any central authority, rendering them theoretically immune to government interference or manipulation.
That's not crystal clear to you exactly what that is?
I mean, the first time that I read this, I was like, oh yeah, now I get it.
Yeah.
No, right? So I think that it's really important, and really when Chris and I first started talking about, how are we gonna put this presentation together? I think our goal for today would be that by the end of today's presentation, you should be able to read that definition and at least have a solid understanding of exactly what it is that it is saying throughout all of these keywords or buzzwords that you see in here. And this really does all boil down to and start with the real fundamental of how cryptocurrency or crypto in general, the blockchain in general can even work. Believe it or not, it's been around for thousands of years. And that is through what is called a ledger. So what is a ledger? Ledger is simply a record of transactions. It consists of inflows, outflows, and a balance. I think that most of the people on this call today have at one point in their life probably interacted with a ledger. Many are probably thinking about those days when you were balancing your checkbook. I wouldn't be surprised if some of you still have a checkbook and you balance a checkbook. One of the wonderful things about having that ledger and that checkbook is when you can, at the end of the month, compare it to your statement, right? I can get my bank statement, I can look at my checkbook, and I can see, hey, is anything off? And maybe I come across or discover, hey, there was a transaction that's here that I don't have accounted for. I didn't buy that. Or maybe there was a double spend that occurred on there, and all of a sudden I caught that. Well, this, as I was kind of researching and just thinking this through, I came across this photo that's on the screen here. And I thought it was a lot of fun, so I wanted to share it with you. Ledgers have been around for thousands of years, right? And so over 5,000 years ago, ancient Mesopotamians started to record quantities on clay tablets. They partitioned the tablets into rows and columns. Within each cell, they drew a picture of the type of item and made holes indicating the quantity of it. I mean, this was Excel spreadsheets before Excel ever existed.
It's a lot of pressure. Don't make a mistake. You're having to re-chisel.
And so through this process, I think we can all agree that ledgers are actually a very valuable tool. And that's what utilizing just one ledger. This kind of moves us forward, and there can be a lot of value and power in using multiple ledgers, which we would call a distributed ledger. And so to help understand this concept, I thought it would be fun if we kind of did a little bit of an example. Let's pretend that at Apriem, 5 of us have been selected at the office to work together on a project. Let's say we're going to do a client appreciation event. And so you've got myself and Chris and Megan and Ben and Jen. The 5 of us have been recruited to work on this client appreciation event. And we've been given a budget of $15,000 that we can use to put this event on. So the first thing we do is we all get together. And we go, you know, I think one of the best ways for us to do this is why don't we split up our activities, right? And one of you will be in charge of maybe securing the venue. Somebody else can be in charge of food, right? Entertainment. And so what we decide is that once we split up those jobs, we go, there's $15,000, there's 5 of us. How about each person gets $3,000 to spend on their job? So we get $3,000 each. The only real rule with this is that we have to determine what we want to spend those dollars on first. And then at the end, we will all get together. And once we've determined how we're going to spend all $15,000, we'll go out and we'll make the purchases at that point in time. And so what we decide is at the end of each week, we'll get together and we'll talk about what it is that we want to buy with our $3,000. And we each log that on our own ledger. We're going to keep track of our own spending as well as the spending of everybody else. So to take kind of a deeper look at this, right? Let's pretend that each of us has a little ledger that looks like this, right? And it starts out with this inflow where we all have $3,000 to work with. And in the first week we get together and we all talk about what we're going to spend on. And maybe I have $1,000 that I'm going to spend on some items, and Chris, he's spending $2,500. And you can kind of see how the whole list plays out there. And so at the end of the week, we all have a remaining balance of dollars that we can spend on whatever else it is that we're missing. So we get to the end of week 2. And now we all get back together and we talk about, okay, I have some more purchases that I want to make. And I have another $1,000 that I'm going to spend. And everyone kind of talks about what they want to spend. And Chris says, I'm going to spend $600 on this food that I really like. Maybe he wants to buy a bunch of pokey.
Absolutely.
But I look at my ledger and I say, Chris, I don't think you have that much available. I show you only have $500 left that you can spend, and you want to spend $600. And Chris says,
well, I wish I had complete control over this ledger because I want to spend my money, but apparently there's checks and balances here, right? So I think we're hinting at the power of a distributed ledger right now. Right?
And so Chris still wants to spend, right? I say, well, nope, you don't have it there, right? And then Megan, Jen, Ben, they all look at their ledgers and go, okay, well, one of the 2 of you is wrong here. Who miscalculated? Well, once I find that the other 3 also show that Chris has already spent his money and doesn't have the extra $100 he needs to spend, the 4 of us get together and we vote him down. Nope, Chris, you've already spent all of your money. Your ledger is clearly incorrect. You wrote something wrong down. And now we can all agree that, look, we have consensus here. Chris doesn't have the money. He can't spend.
My first question, just to be clear, am I having to do a ton of math to use cryptocurrency?
No.
Okay, just double checking. It's starting to get complicated.
In fact, that is a great segue into what we're talking about next here. So what I want everybody to do is I want you all to take this is really a small concept, right? It's been broken down into a really simple manner, but I want you to expand it. And instead of thinking of individual people that are handwriting this ledger down, I want you to imagine that each of those people themselves are actually a computer program that is holding the ledger and doing the math on your behalf.
Thank you.
So that when Chris goes and he wants to spend those dollars, that opportunity to spend then gets broadcast out to all of those computers that are all holding those ledgers for all of them to look at simultaneously and say, does Chris have the ability, does he have that in his account? Does he have the balance and the funds needed to make this transaction occur? Now, that is what you would call in this case, if we were talking Bitcoin, that would be the Bitcoin network. It's all of those computers, which are called nodes, dispersed. They're all working together to look at each of their own list of transactions. They all have their own list that they can all compare and contrast and essentially vote on whether or not Chris has the ability to make that transaction.
So just to be clear, quick summary, just so I'm on the same page. So far we've covered distributed ledger. Now we've hit on decentralized network and then also the term node. So a node essentially sounds like more of like a gatekeeper of that ledger, verifying some transactions, basically enforcing the rules of that network.
Absolutely,
Okay.
absolutely. And in fact, that's a really important point, right? Chris said enforcing the rules. So technically, in this disparate network of nodes, you also have what are called miners, okay? And while there's these miners that are interspersed throughout here, miners are also nodes, but not all of the nodes in the network are also miners. So I think that's an important piece for us to cover as we move into this next piece here. The nodes are all going to make sure that the miners are following the rules that have been set out, at least for this network. All right, and we'll talk a little bit more about what are those rules. What do we mean when we talk about enforcing those rules? All right, so let's move forward. Now we have talked about nodes and miners. All right, and I'm just going to reiterate. All miners are nodes, but not all nodes have to be miners. Okay, and so we're just going to put that right here on top, because this is going to get us into talking about that concept of mining, which you hear out there. There's, in fact, we're going to talk a little bit in the future here about miners and the amount of power consumption. There's a big conversation about the power consumption that's happening with these miners, but what exactly is crypto mining? What is being accomplished? Why does it take so much power?
Yeah. Before we go into it, what helps me kind of because that sentence seems confusing, right? But I would say that it makes a little more sense when you think about a miner as kind of condensing. We'll get into that, following the rules and condensing transactions and keeping it orderly. In order to do that, you also need to keep track of the ledger yourself. That's why to be a miner and node is a combination. Whereas some people don't want to go through the whole mining process and all the stuff that we're going to talk about, and they just want to be a node. And then there are plenty of people that don't want to be either, and this is just how the network works. So again, to be clear, you don't have to do any of this. We're just explaining the technology behind it.
Yeah, that's a great point. You do not have to be a node, and you do not have to operate as a miner in order to transact on the network, right? So you could send crypto, you could receive crypto, you can transact on the network without being either of these two pieces. The same way you could get on the internet and you can interact with the internet without having to operate a server or a website.
Right.
Okay. So pulling it back here, each of these nodes and miners, they are holding this ledger of transactions. And there's all these transactions that are occurring all simultaneously, right? Chris wants to buy a cup of coffee and somebody else wants to buy something else. All these transactions that could occur, maybe we're sending money back and forth between each other. All of this is open source, right? So what's to stop somebody from going in, right? Some hacker is going to go out there and he says, oh, I'm going to go ahead and just type into that open source code and give myself $1 million, right? And so what's stopping him from doing that?
So nodes enforcing the rules.
Yep.
And then, man, it'd be convenient if miners were to be able to condense all that into a block or something.
Well, lo and behold, that's what they do. All right, so these miners are periodically taking all of the transactions that have occurred and they are squishing them down into a single block size. All right, now, if we were talking Bitcoin, we're going to spend majority of the time talking about Bitcoin because it kind of started everything. All right, if we're talking Bitcoin, that block size is 1 megabyte large, all right, which is actually relatively small. And this process of condensing all those transactions down and then encrypting that information is what is called a hash function. And the actual hash function that's being used, I'm showing here on the bottom where it says SHA-256. It's not important that you know this SHA-256. I will tell you just for the fun of trivia, the 256 stands for the amount of bits that exists inside of that hash function, and 256 bits, so think ones and zeros, each one of those is a bit, that translates to approximately 64 characters. I want to spend a little bit of time on this because this process of condensing that information down into a block and then encrypting it using this hash function is a very complex mathematical puzzle. And I use that term puzzle because I think it is the perfect analogy to think about here. So I want everybody on the call to imagine that you have a puzzle and it is the size of a piece of paper. It's 8.5 by 11, but it's only 2 pieces, right? You have 2 sides to that puzzle. That would be a very simple puzzle to solve, right? You actually have a pretty good chance of dropping that puzzle down and getting those 2 pieces to fit together, right? And dropping it into a perfectly finished 2-piece puzzle. However, if we take that puzzle, same size, 8.5 by 11, but we chop it into 100 pieces, 200 pieces, 1,000 pieces, 2,000 pieces, the complexity and the amount of time it takes to solve that puzzle, it becomes much more difficult. Now imagine that you had your 2,000 piece puzzle and you were going to drop the pieces down and have them all fall randomly into the right place. That essentially is what a miner is doing when using this hash function. They are dropping those pieces down randomly so many times that eventually it hits the right place. When one of these miners does that and solves that puzzle, they now can add that block to the blockchain. So each one of these blocks that's added to the blockchain is one of those random puzzles that has been this information, all these transactions that's been condensed down into the 1 megabyte block size, randomly encrypted, okay, and then it gets added into the blockchain. Now that's an incredible amount of work and it takes an incredible amount of processing power. And the program has been set in such a way that these blocks are being solved at a rate of approximately once every 10 minutes.
So just to pause for a quick second, because we've gone over a lot already.
Yes.
So just a quick little summary. So far I have in my head nodes, right, that are enforcing the ledger, enforcing the rules of the system that we're describing. And we're going over rules now. The miners are actually following those rules, organizing everything into a cryptographic, so making it safe for people to use essentially, down into a block. That block has limited size, so there's not like an infinite amount of transactions you can fit in each block.
Correct.
But they're ordering that. And then they're adding and consolidating that in that block, and then adding that on as a chain effect, essentially where blockchain comes from, block after block after block, at approximately 10 minutes per block.
That's correct. Okay. And those are all very finite rules that are being followed here. 1 megabyte in size, solving once approximately every 10 minutes. Now what happens is whoever the miner is that solves that puzzle is given a reward.
Like striking gold.
Like striking gold, right? You were digging, you're expelling energy, right? Eventually you're doing it for a reason, right? You were digging, you strike gold, right? You got your reward. Only when it comes to something like Bitcoin, that reward is hard coded into the system. We know exactly what the reward amount will be, whereas if I'm digging for gold, I don't know what the size of the nugget's going to be, right? And so in this case, currently the reward for solving one of these blocks is 6.25 Bitcoin. That's the amount of reward that is paid to whoever the miner was that actually solved that puzzle.
So about $250,000 US, give or take right now, plus some transaction fees.
Absolutely. Now, here's a very interesting rule when it comes to the Bitcoin blockchain. Every 4 years, the amount of that reward is cut in half. Now, we're about approximately halfway through that 4-year period right now. And so when you're listening to the news and you start getting closer to this event that you hear out there called the halving, this is what they're talking about. They're talking about that reward itself being cut in half. All right, and you could track this all the way back. Every 4 years, this reward has continued to get cut in half, where it's slowly but surely constricting the supply or the flow of supply that's being added into this Bitcoin network or economy.
So opposite of inflation, we're condensing supply, essentially code creating some scarcity, which again, can't break that because everyone's following the same rules. It's this big decentralized network, right? That makes sense.
So really quick, just to summarize, the nodes, we keep talking about them enforcing these rules, right? So in this case, we've talked about one of the rules that the block size can only be 1 megabyte. that those blocks need to be solved at roughly a rate of 10 minutes, that the reward is 6.25 Bitcoin right now, and that every 4 years that reward gets cut in half. These are all rules that those nodes make sure that the miners are following as we go through this process. And I think with that, I think that's a good time for us to transition now into our next topic, which is, well, we talked a lot about Bitcoin, but we have all of these other types of coins that are out there. Chris, you want to talk a little bit about why we have so many different types of crypto?
I do. So I'm just going to take one step back for just a second and say, okay, so we have all these rules here. What if I disagreed with this process and I said, well, wait a second, I would rather have a much bigger block. So it's going to be harder for nodes to keep track of it, but I think that's worth it to be able to fit more transactions into it. And I want a faster blockchain time and yada, yada, yada. I want more reward or less reward, right?
Sure.
And so what happens is, and why there's so many different ones, is that obviously it's hard to agree on one rule set being the best for every crypto asset that we're going to talk about. And so you'll see it as a hard fork, right? There's a term there. Basically what they're doing is they're copying over code, altering the rules, and then running their own system. So I think it's natural. Humans tend to be tribal about things. And so that's what's happening here, is you have people disagreeing on certain things and then starting their own, and you're able to kind of populate that. Now, with that being said, with network effects, certain ones certainly have accrued more value, more people, et cetera, et cetera. And so what I wanted to do is just kind of take one huge step back for a second, because when I was learning about this, currency, and the more I read about it and the more I learned, it's like, wait a second, very few of these are actually trying to be currencies. Yeah. And it finally clicked for me that actually what's happening here is a lot of them aren't being currencies, or they would make a terrible currency.
Right.
And yet everything is lumped together as cryptocurrency. So I'd like to reframe that to crypto asset or crypto asset classes. And so what you're seeing on the screen here is kind of an amalgamation of maybe 4 different major kinds. There's a lot of different subkinds, but I'm just going to pick on 4 for a second. So first you have Bitcoin. First thing I want to say about Bitcoin, I found this interesting. It's actually not the first cryptocurrency or crypto asset. It's the first one that's been successful, but this has been being developed for more than 40 years. And that made more sense to me too. It's like, wait a second, so this isn't the first time, it's actually been perfected over 40 years, and now we have Bitcoin. So that made more sense. As far as the store of value goes, I think a Bitcoin proponent would say, well, we have something that is fully decentralized. There's no CEO that you can call in, right? And it's not inflationary. We just went over how the reward gets halved over time. And so I think the concept here is it's almost like digital land, if you will, where there's only so much of it, there's only so many. It's introducing artificial scarcity. And then as normal currency, like the US dollars or yen or et cetera, get printed and more inflate in the system, I'm going to have something that doesn't inflate. And therefore, I'll catch some of those currency as a bid on the price. So it's a store of value in that sense. It's easily transferable across space, scale, and time. So it makes an interesting form of savings or money, because sailing across space, well, I could literally send this overseas to someone, somewhere else, and then I'm not having to worry about international conversions or currency conversion, et cetera, et cetera. A Bitcoin is a Bitcoin is a Bitcoin everywhere it goes. Scaling, we can talk about this more, of course, but it can actually, you don't have to just have one, you can scale it down. There's actually 100 million little pieces in each one, so there's fractions of them. And by the way, it's open source code. We could easily just do essentially a stock split and make it even smaller if you need to scale it more, right? It doesn't change the size of the pizza, just makes the pizza smaller, right? And then it's hard and slow to produce, and that's what Bitcoin's trying to be. Limited supply, hard and slow, ossified rules. Now, we move to something like Ethereum, which is, I think, the second biggest right now by far. Bitcoin's about $1 trillion, give or take. Ethereum's about 500 billion, 400 to 500 billion, give or take, in terms of its monetary network value. And for Ethereum, it's not trying to be Bitcoin at all. The tribe of Ethereum is more about completely open source blockchain, and almost, this is simplistic, but imagine if the Apple App Store was completely open source, and you had all apps able to see all the code of other apps, and you could just easily replicate, but then build on top of that, iterate, and you have millions of people doing that. What would that be like? That's kind of Ethereum, which is interesting. The possibilities are a lot there. But then again, they're making a trade-off, right? So in order to satisfy and be able to do all those kinds of transactions. They have a very different mining process. They have a very different block size, right? It's a little bit harder to run a full node on that, in my opinion, right? There's other things like that. And so it makes trade-offs. The third kind we talk about is one that's actually trying to be a currency because it's pegged to currency. It's called the stable coin. And then the last category, I get asked this one a lot, is about Dogecoin. And really, why I wanted to say this is that because humans tend to be tribal in communities and things, Dogecoin was literally started as a joke. And it was basically, we just talked about all Bitcoin's rules. It's what if we just flip those rules on its head and made it super inflationary, like 10,000 new coins produced every minute? Wouldn't that be fun? And that's what they did, right?
Yeah.
And there's no maximum supply. It's incredibly inflationary.
Yeah. And so just to reiterate, there are literally thousands of different types of coins or altcoins that are out there. And this is just to name a few to give you guys an idea of, why are there so many different types? What is happening? Lots of them have these different stories and different purposes that they're trying to serve, or even different potential problems that they're trying to solve.
And make serious trade-offs to accomplish that goal. I can't say that enough. There's really big trade-offs that you have to be aware of as an investor with all these different kinds of crypto assets. Okay, so the next category here, we're going to do frequently asked questions. And so the first one we're going to talk about is a pretty hot topic, is does Bitcoin or mining in general consume an unsustainable amount of energy? Because that mining process we described is really energy, and it can be energy intensive. It's a competition. It's like a race to solve that puzzle. The more energy you throw at it, the more computing power you throw at it, the better chance of getting that reward. And that's why there are certain crypto assets that choose an entirely different form of mining that doesn't use lots of energy, right? And there's an interesting debate between all of that, right?
Part of the conversation comes down to, you think about all these different things that we expel energy on around the world already. What is the purpose, and does it serve a purpose? Is there meaningful value that's being added in the way that we spend this energy itself? I think that's a big part of the conversation and the debate between somebody that's a Bitcoin bull versus a Bitcoin bear.
Why not just get banned? And so I think the first thing I want to say here is that, especially coming from a finance professional, there's a big difference between being banned and being regulated. And you're kind of seeing on the screen here, there have been major countries like China and some others that have literally tried to ban this. And I think they're on ban attempt number 6 or 7. Okay, so, and I'm not trying to pick on Paul here, who is a well-known Nobel Prize winning economist, but I just wanted to point this out because, everyone can read the quote there. Basically made this bold claim that the internet's impact on the economy has been no greater than the fax machines by 2005, right? He made this in 98. Now, at the time, that wasn't that bold of a claim. It was a big debate, right?
Sure.
And also, too, I could have picked, there's a really famous, funny YouTube video for anyone else to look it up, where Bill Gates, a young Bill Gates, is trying to explain to a much younger David Letterman about the internet. And David Letterman basically just asked him, like, why would I even need that, right? And Bill Gates is trying to explain the potential and what could happen. And so does it even have value? We could attach this from a lot of different ways. One of my favorite ways to attack this for a second is forget crypto for a second. Just pick any asset, Josh. So let's imagine the home that we're in right now. If for whatever reason, just arbitrarily, hypothetically, no one ever was willing to buy this home from me, could I sell it? What would be the value if no one was willing to buy it, right?
Zero value,
right?
Yeah, zero.
It's an extreme example, but you get my point, right? When something has value, it just means the other party is willing to part with some of their monetary energy or monetary capital for that asset, right?
Yeah.
And at this point, I guess now we have more than a decade worth of people saying, yeah, it does have value. So that's the first part, right? So value can be somewhat subjective. Can it just be copied, right? Like, it's just open source code. I could just create another coin tomorrow and call it Chris Coin. You could totally do that, but first of all, no one but maybe my wife and family would humor me and buy that. So what you're seeing on the screen here, the darker line is Bitcoin's logarithmic scale of price. And you're seeing other attempts to copy it priced on that same logarithmic scale, and they're basically all trending towards zero, essentially. Right? There's a couple in the top, right? A couple of ones that have been able to keep up somewhat, but for the most part, copying the network has been hard. And then I think I just put this broad category at the end here. Isn't it just a scam, right? And I completely understand where people are coming from. I certainly felt this way as well. And I think, again, I don't think I get this question as much anymore, But just in general though, right, there's a lot of categories here. Is it just used for crime? Is it a Ponzi scheme or a pyramid scheme? Is it just ransomware essentially, right? And I think a couple of just broad comments here. First, it's just an open source tool. So to be fair to anyone who's a proponent of crypto assets, a chef's knife is iconic in horror films as a weapon, but at the same time, a chef's knife, most people just use it for chopping things up and putting in their soup or whatever, right?
In the hands of Gordon Ramsay, but a very different purpose.
Exactly, right? And so that's, it's just a tool.
I think this is where the things like we talked about previously, like regulation, I think is really, really important. I think education is really important as well. If I give my grandma, who never uses the internet, access to the internet, and she gets the email from the Nigerian prince, right? She's just not as educated on what she should be paying attention to and what's safe and what's not safe.
Right.
So there's scams that are happening all over the place. I think this is another tool that does get used for scams. So it's important to protect yourself by being well educated.
Exactly. Okay, so what we're going to do next is go over some current applications and I think interesting actual use cases and developments, because some people might still be thinking, why do I care, right? And so there's kind of some interesting things here. So the first one here we're going to talk about is NFTs and broad applications of NFTs. What an NFT stands for is non-fungible token. Fungible, right? So a fungible thing would be two identical pieces of paper or two, I have Ricolos here for my throat.
Which one do you want?
Exactly.
Which one's more valuable?
Right. Those are completely fungible, interchangeable. I don't care, right? I can close my eyes, pick one, and it is what it is, right?
They both have the exact same value regardless.
Now, if one of these was signed by Tom Brady for whatever reason, or pick your favorite athlete or whoever, one of them would not be fungible. Like I would want to know which one had the autograph, and that one I'd much rather have, right? And that means they would be non-fungible, right? And so for non-fungible, the easiest way I remember this is it just stands for unique. It's a unique token, it's unique, right? Has a unique hash behind it, right? And so, or maybe even like an autograph is a decent example, right? It's autographed by, it's the original, it's this first edition, et cetera, right? It's provable by code. Okay.
Ooh, stranded energy recapture and stabilizing power grids. Chris, what the heck does that mean?
Right. And so I promised energy would come back a couple more times. This is one of those times. Exxon is dealing with greenhouse gas emissions by mining crypto, right? Well, that headline. Seems really counterintuitive, right? And so to be fair to Exxon for a second, they're just doing a pilot program. I think it's in North Dakota, but anyways, it's a pilot program. So this is a new thing. They're testing it out. We don't know where this is going to go. And so what's happening is, and again, there's a lot of refinery clients listening or watching this right now. So you know the flaring concept much better than me, but just a basic understanding is that things go wrong. Sometimes natural gas needs to get let go. And instead of just releasing it into the atmosphere through the stack, they burn it to burn the methane off to make it more environmentally friendly. So releasing CO2, but the methane gets burned off. So that's just wasted energy right there, right? Now what's happening is they're actually trying to capture that natural gas. Instead of burning it off in the atmosphere, they capture it in a generator. That creates electricity. You have a source that has flexible demand 24/7, so they can use that electricity, and then they're mining Bitcoin with it.
So hey, instead of having to flip the switch to flare, we now flip the switch to mine, right, until we get things corrected.
And actually reduces greenhouse gas emissions, right? So just
pretty intriguing.
Really interesting concepts that are happening.
I think that does a good job of segueing into this next topic, which is El Salvador. So
yes.
What's been going on with El Salvador?
So this is basically just a brief case study on a country that's actually putting a lot of these concepts to work. So it's a brand new experiment. Again, to be fair, we don't know how this is going to turn out. But what they're doing is they have dormant volcanoes in El Salvador. And they have all of this geothermal energy that currently, I mean, it's more than enough to power the electricity for what they need, but there's tons of excess that just gets wasted, right? And so what they're doing is they're taking that excess geothermal energy and monetizing their volcanoes, essentially in a way, right? And mining Bitcoin with it. It's like something out of a sci-fi novel, but it's literally happening. And on the top right, you have, obviously when you adopt new technology, it's kind of an interesting side effect. You get the tourism sector is up. They're getting higher quality tourism. It's a big part of their GDP, so their GDP is skyrocketing. And then on the bottom right, I think this is the most important from a human element that was interesting to me. So El Salvador, these stats are taken from them, is basically, at least as of 2020, 23% of its GDP as a country is remittances. Remittances, simply put, is basically sending money over there to help someone out that you know there, right? So there was nearly 6 billion in remittances where people were sending money to go help a loved one in El Salvador. And the current system is more slow and cumbersome at Western Union, MoneyGram, et cetera. And a couple of things happened. My understanding is, first of all, it's expensive. So about 400 million a year now actually goes to the person you love and you're trying to help, as opposed to going to a fee. And the other thing too is it's safer, much safer. So I guess people are having to collect it in person. There's a lot of gang violence and things that happen at these centers to go get your remittance payment from your loved one. And now you can just right there, right on your phone or technology or computer, et cetera.
Yeah, it just shows up.
It shows up.
So I think a couple pieces here too that we don't want to miss out on is that, you know, one of the things that happened through this whole process is El Salvador began to accept Bitcoin as legal tender, right? And so that allowed some of these other pieces we're talking about, like the tourism and everything to happen, right? Because tourists can come and they can have their Bitcoin and then go and spend it anywhere, you know, in the city. And then at the same time, you've got 70% of El Salvadorians are unbanked, right? And so I just want you to think about that for a minute. You know, this means that I'm going to my job, I'm getting paid, you know, I'm taking my cash and I'm storing it, insert here, right? Is it going under the mattress, right? Going in the safe, however it is that I'm storing it. That's where I'm taking my money. I'm not having it auto deposited into my bank account. I don't have any money in a bank account. I don't even have a bank that I use. And now it comes time to go and pay my electric bill. All right, and you can go online. I can remember watching some of these news stories as they were first releasing, and they had a gentleman that was describing this story, right? When he had to pay his electric bill, he'd have to go and he'd get his cash. He'd hop on a bus. It was about an hour and a half drive into the city. He shows up to the electric company, stands in a long line because he's not the only person that has to go and pay his bill in cash, right? Stands in line for an hour, 2 hours, pays, hops back on the bus, hour and a half back home. He was talking 6 to 8 hour long day just to pay the electric bill. And then they've got him on camera there on the spot, and he sends his payment to the electric company via Bitcoin, wallet to wallet, and it's done, you know, instantaneously. Now that doesn't sound like that big a deal to us, where most of us are all on these, you know, auto payments for all of our things. But for a nation that's out there where people, 70% of the population is unbanked, you know, that's a big deal.
Absolutely. Yeah, it kind of checked my privilege for a second to think about that, right? Like I take a lot of it for granted, the things that we have around us. So it's kind of interesting. Now, the last one here is a concept that would apply to more first world countries and things like this. But so we have Web 1, Web 2, Web 3. Web 1, which was essentially read only, right? You had news and maybe some pictures of things that you were looking at, right? It was just reading and taking in information. Web 2 can often be defined as, but it's participatory, right? You can actually own your own websites and you put content out via social media, et cetera, right? It's a read-write environment, like it's an interactive environment.
Sure.
But some people don't like the fact that that's centralized and essentially your stuff is being mined for data. Your data is being collected and monetized from these other companies, right? And so I think a lot of people think it'd be nice if you actually owned your own data. And that's kind of some of the concept of Web 3. And this is brand, you know, it's new, so there's certainly a lot of kinks that we could talk about, but basically Web 3 is read, write, own, right? To where you can actually own your content, whether it be as an NFT, Bitcoin, et cetera, you own your value, right? And I think one kind of interesting application to me is, I think about Web 2, and so I have my social media login over here, I've got my Google account, I've got this account, right? I've got all these different usernames and logins where I have some stuff here, some stuff here, some stuff here. Web 3 is more, I have all my stuff. I just click a single sign on and all my stuff is loaded and I'm ready to go.
But let's get into some Q&A. So Megan?
This first one's good. How is cryptocurrency taxed? And if it is, how?
To be fair, some of this is being debated, but I'll tell you my understanding of some of the current rules. First of all, it is absolutely taxed. It's not some big tax that will just use crypto and not be taxed. Because if you look at your 1040 this year, on the first page of your 1040, you got to check if you have anything, right? And so basically the way to think about this is it's almost like everything's interacting in a taxable brokerage account, a non-retirement account, even when you do simple transactions. So I take Bitcoin and I convert it to cash and cash back to Bitcoin, that's taxable limit. I do Bitcoin to a different crypto. I trade Bitcoin for Ethereum and then Ethereum for something else. That's a taxable event, right? Whenever there's some kind of a change, even things like NFTs, right? They're taxed as a collectible, right? So you have your cost basis that you purchase. There's maybe some potential gains there. You sell that, right? And so there's tax across the board here, right? But yeah, so that's the first one.
I mean, I guess, the bottom line is if it's, for the most part, it's being treated like a capital gain.
Mm-hmm.
So you should be reporting. That's what you're supposed to be doing. And and if and when you do, depending on how long you held it, it's going to determine what the taxation is going to look like.
Yeah.
Okay, so right now one Bitcoin is worth just over 45,000. And I don't know if I want to risk so much money buying one whole Bitcoin. Is it possible to buy a fraction of Bitcoin? Are there subunits of this? Kind of like what cents are to the dollar?
Ah, good.
So, I mean, to answer your question, yes, we talked about it a little bit before. Chris mentioned scalability, right, or divisibility as being the other, another way of looking at it. So, yeah, Bitcoin is divisible up to 1 million times per Bitcoin, and they could technically, it was not very difficult for them to change that even moving into the future. But for trivia, just so that you can wow your friends, all right. So we know one Bitcoin is worth the 45,000 plus whatever the value is right now, right? But when you break Bitcoin up into pieces, each one of those little pieces is called a sat, which stands for Satoshi. And Satoshi Nakamoto essentially is that anonymous person who is credited with, it's the pseudonym for the person that is credited with being the founder of Bitcoin, who we do not know who that is. So just a little fun trivia fact for you there. We can talk more about that too if you guys are interested. But
I just saw a brief one come in. Is the only thing needed for mining a powerful computer? I'll just take that one real quick. A powerful computer certainly helps. It's not technically necessary. It's going to be hard to win that race without it. That my understanding, there are people that have little things called like ant miners and things. They're just not very simple computers. And they just have them constantly searching. And there's a small chance that they win the lottery and that one little miner hits that block.
It's just a piece of software that you put on the computer and you run, and it does the mining. It does it all for you. And so when everything initially came out, I mean, people could do it on a laptop, 10 years ago. And so you can imagine the computers we have now are even more advanced than those were. But theoretically, you could go grab one of those laptops from a garage sale, throw the software on there, and get it to run. The question is it economical? Mm-hmm. Right? Is it because a lot of these processors that are out there now that you see, on TV, and you see the racks full of those mining processors, they're only doing one thing, and that's just mining Bitcoin only, or whatever cryptocurrency it is that they are mining. And they're made to be very, very energy efficient. And then Chris is right? So I talked about the example of dropping the puzzle down, landing in the right configuration. Well, if you had one person doing that, the chances of him getting it before a million people that are all doing the exact same thing is severely hampered, but it could happen.
Mm-hmm. I see one coming through. When is the final year into the future? I'm assuming that means on the Bitcoin supply schedule. So just a brief, again, it's not perfect because it's about 10 minutes on average, but it's about the year 2140 or so, just the way that the halving continues to work. So it's about 2140 or so. And then it's just going to be the transactions that are running up.
There will be only 21 million Bitcoin that will ever be mined, but that's just Bitcoin. Who knows what else will be created over that same time period.
Yeah.
Mm-hmm. This one is, should I keep my cryptocurrency on an exchange or can I transfer it to an iPhone wallet? Are there special devices I can buy to store cryptocurrency?
That's a great question.
Yeah. Mm-hmm. So I want to put just a real quick disclaimer here for a second. Once you put it onto your own wallets and hardware wallet, it's hardware wallet or cold storage, different ways to say that, you are becoming your own bank truly. And so that's where people can get into trouble. That's where all those big news items come, like, oh, I forgot my password and now I lost
$8 million.
Yeah, right.
Disappeared.
Yeah, that's when someone tries to take it into their own hands and they're it's like running your own server than something going wrong with the server, essentially, right?
And I just saw one more interesting one come in. What is the difference between mining and investing?
Ooh,
between mining
Yeah.
and investing. Okay. You could look at this twofold, right? Okay, I think a gold miner is a great way of really thinking about it, right? If I am a gold miner, maybe I borrow a bunch of money and I buy a bunch of equipment and I hire some folks and we go out and we get a plot of land, right? There's a lot of initial capital that goes into getting all of that set up. Then I start mining and then I get the gold. And what do I do with the gold? Right? Well, I put all this initial investment and capital out there so that I could create this business, get that gold and go out and sell it, right, to begin to turn a profit. And then if I'm a gold investor, I'm not gonna spend a bunch of money on investing a bunch of capital into this business to get the business running so that I can get the gold out and then just save and hold the gold. I'd rather pay somebody else to do the work, and I'll pay for all those extra, the cost of doing business, and then I'll buy the asset itself and I'll take it and I'll put it, in my safe and I'll save it.
What do you mean by the halving cycle, and is it only specific to Bitcoin? I think you both touched on that earlier at the beginning of the presentation.
Yeah, well, so in general, so halving cycle is something that well, it's about every 4 years, but the mechanics behind that is actually number of blocks. But the number of blocks usually matches up about 4 years from the time, from each halving. And it's the way to stretch out the supply schedule, and also it introduces some artificial scarcity essentially by lowering the block reward over time, and it stretches over a long period of time. That's why one of the earlier questions was how long does the schedule go? Well, it goes to 2140 because it's going to constantly. So just to put this in perspective, I believe the 19 millionth Bitcoin is being mined sometime this week, as far as rewards. So we go from 19 to 21 million is the full schedule. So we've gone almost 19 million at 21 over what, the 10, 11, 12 years, give or take. And then it's going to go all the way to the year 2140 because it keeps getting cut in half and then half and then half and half. By the year 2136, it's going to be very, very tiny amounts. But I think the idea would be that it continues to pick up in value over time. But again, speculative.
And so yes and no to the question about is it specific to Bitcoin. So yes, it's specific to Bitcoin. It does not have to be specific to Bitcoin, but if you think of something like we talked about Dogecoin, right, where the reward is 10,000 coins to whoever's adding that block to the blockchain, right? 10,000 coins, and they're solving at a rate of every 1 minute, right? So their hashing is less difficult. They keep it down really, really low so that those blocks can be solved every minute. And there's an unlimited supply. So that 10,000 coins that's going to be rewarded stays consistent. That's never getting cut in half. And so could another coin come out and say, yeah, we want to do something that's deflationary and constrict, and we want a halving, but our halving is going to be once every 10 years. They could do that, right? So it's really up to the protocol of whatever that coin is that they decide to use. I hope that answers the question.
Yeah.
That was great. All right, I think the last one for today is crypto truly an uncorrelated bet with the stock market? And it seems to have been correlated with the S&P 500 lately.
Yeah, well, okay, so ordering the questions was, okay, so basically the one before that talked about the halving, right? And so when something just cuts its supply schedule in half, it's going to be uncorrelated from things, right? So I think if you were to look historically at when it's been uncorrelated from markets, something specific to the asset class is happening. And so it's not correlated at all during those periods. Now, lately, though, we're a couple years into the middle of a halving. And so it makes sense logically that there's not like some huge necessarily event that's causing it to spike or decline or things like that, right? And so it's moving in general with growth assets.
Thank you so much and have a great day.
Thank you.
Bye, everyone.